What is exactly a housing bubble? How do we know we're in it? How do we know it's going to burst? Where do all the houses go? What's the market trying to tell us? That's what we're going to get into right now. Hello and thank you for watching. This is Wayne Turner. I'm a real estate broker in Tennessee as well as New Orleans, Louisiana. But before we dive in, please subscribe and like our video. The best compliment you can give us is that, so we can continue to help others. If you find this information informative, just simply share it. Most appreciate your doing so. So what is a housing bubble? I'm going to keep it quite simple because I like things simple. So a housing bubble is when there's a large number of homes on the market. Not necessarily a large number, but there's homes on the market and buyers are purchasing those homes. Now, as the rate that buyers purchase homes go down and the houses come on the market, you get an unbalanced market. So you have more homes on the market, less people buying those homes, which can cause a bubble. Now, many of you have heard the stories, and perhaps you've even remember and experienced the housing bubble and the burst that happened in 2008 and 2007. Now, that's similar to what happened then. We had homes coming on the market, and we had fewer buyers. So as the fewer and fewer buyers were purchasing and homes were on the market, and they continue to come on the market, but fewer buyers purchasing those homes, it literally creates a logjam of homes, if you will. Now, keep in mind the years leading up to 2007, 2008, 2003, 4, 5, 6, the housing market was incredible. We're selling houses and it was perfect and it was just absolutely, you know what it was? It was rainbows and butterflies. So, what happened? Well, during that time, we had a thing called adjustable rate mortgages, and we also had a thing called subprime lending. And then we also had a situation where people were qualified for homes based on such an adjustable rate and subprime loans, meaning that they didn't have very strict, stringent qualifications to purchase a house. Now, with an adjustable rate, adjustable means that it starts low. So the buyer would qualify for 2.5–3% rate on an adjustable rate mortgage. Now, that adjustable rate mortgage will then can increase over time. So imagine if you're literally sitting on a 2.5–3%, you purchase your house 3 years later, now that rate's at 8%. So your payment goes from $1,200 a month to $2,000. Your payment goes from $1,300 to $1,900, $500, $600, $700 jump literally in the period of a year or two, just owning your home. And so it seems the lending process, that thought process of lenders was, look, we'll loan people money. They qualify. Once they qualify, they purchase a house. They're going to pay their mortgage. Rates go up. They still pay their mortgage. We make a little bit more money. So we made it on the front end, giving the loan. We make it on the back end, servicing the loan. It's a win-win, right? People get a house, banks make money. And please know, I am not knocking banks. Banks have to make money. We all have to make money. There's no sin in making money. We have to make money to survive in society. So the banks, what they did is they loaned a lot of money to a lot of people. And in doing so, they created what they call mortgage-backed securities. Now, they would take those mortgages and bundle them up. And from bundling those mortgages up, they would then sell those mortgages to other lenders, other investors, if you will. So they would take, offer loans, package them, and they would sell off literally 100. You've heard of somebody servicing your loan, or perhaps you've had a mortgage on your property, and then after a year or 2 or 6 months, sometimes they do it right out of the gate. You get a notice after you've paid your first mortgage payment that the loan has been sold. That's exactly what they're doing. They're selling the loan, and they've done this for years. Nothing that's new. It's been going on for years, and they package those loans and then sell them. So it gets it off their books so they can continue to do more. So the banks will make money on the front end and they'll make money on the back end. Now, all was fine and well until the mortgage rates began to increase. And as they increased, so did people's mortgage payments. And that led to the default in a lot of people paying mortgage payments. As I mentioned, consumers see mortgage payments on adjustable rate mortgages go up $600, $700, $800, some more than that, over a period of less than a year. Now, add to that, during this time period, the gallon of gasoline was $5. And with gasoline and $5 a gallon, you look at the average 18-wheeler rolling down the road cost about $27,000 just to run that truck for a year. So what happens is we've seen a surge in layoffs. We've seen companies cut back. We've seen companies cut back in jobs. And in doing so, it caused hardships, and people literally fell behind on their mortgages in record numbers. And of course, with this came the hype of the media, and the media has to, they have to let us know what's going on in the world, right? But negativity sells. We all know that. And as people heard the negativity, you can't help but wonder, well, wait a minute, anytime something changes, happens, shift in our economy, it's shifting in our lives, and we take a step back and we just kind of freeze. Quite simply, people stopped buying. As a result, people began putting their houses on the market, not because they wanted to put their house on the market, because they simply had no other choice. They literally had to find less expensive, affordable housing. They had to go somewhere else. They had to move. They were faced with becoming behind in the mortgage. And of course, once you get behind in your mortgage payment, so much as 1 or 2 payments, if you're late on your payment, then the banks, mortgage companies, they want payment in full. They don't want just one payment. They will not take partial payment. So for them, if you're late on a payment and then you want to pay that payment, but you're a month behind, they're not going to let you just roll with that. That's not going to work. They want you to make it up instantly. So they want what they call payment in full. And that is the payment you missed, or the payments that you missed, and the payment to make you current, which, as you can see, adds up to a lot of money. Sometimes $6, $7, $8, $12, $15,000, sometimes even more, bigger numbers that would blow you away in the hundreds of thousands of dollars.
Holy moly.
Now, added to that, we had more foreclosures on the market. We also had more short sales on the market. I'll speak on that in just a second. And then we had people putting their house on the market just to literally because they had to, which caused a surge in homes being on the market. So now we have homes being placed on the market. Homes are on the market. They have to sell. You have foreclosures where people have already been through the process, because there's always a foreclosure market. Isn't that funny? Until the moratorium, and I'll get to that here in just a second. We'll talk on that. But included in that batch now is short sales. Now, a short sale is simply where the mortgage company will take less than what is owed on the mortgage. So if you have a hardship, they won't do it unless you have a hardship. But if you have a hardship, a death in the family, a divorce, an illness, cut back in hours, cut back in job, loss of job, anything like that, you can write a financial hardship letter. But keep in mind, banks want to look at absolutely everything that you have. They want to make sure you're not harboring any funds, cash, or anything like that, which I know, I get it. If you're listening to this, like, well, wouldn't people pay their mortgage payment? Yes, they would. And that's exactly what they tell me. Well, if I had the cash, I'd pay my mortgage. I don't want to move from my home. So they would put the house on the market, and we would negotiate with the bank to short sell the property. And that would cause the bank to take much less than what is owed on the property. And they agreed to do so, and that was done by the thousands. So now you have thousands of more homes on the market. There's more homes on the market and coming to the market than there are buyers consuming. So it makes it a buyer's market. It's beneficial for the buyers to make purchases because they can pick and choose the property that they want. They can make low offers, because now you have all these homeowners that are selling in desperation. You got short sale properties, foreclosures, homeowners, and of course, that'll bring down the home values. Not only did prices come down because people had their house on the market, they needed to sell it, they wanted to sell it, they had to come down in price, because you have to keep in mind, it takes years for this stuff to develop. It takes years for consumers and people by the millions to understand we're in a good market. So for 4 or 5 years, we were really blazing in a hot housing market. Now, what is today our housing market in 2022 telling us? So what is it trying to tell us? What can we stop and look at and try to think, what is it? Where's it going? Is it a bubble? Will it burst? We know what a bubble is. It's a lot of houses and people not buying, and you just have to reduce the price of houses and it's just going to burst because people aren't there. The big difference today in 2022 is there's fewer houses on the market than there are buyers. There's quite simply thousands of fewer homes on the market and buyers. Now, it's not so much as there's a whole lot more buyers. It's just that there's a whole lot less homes on the market for sale, which creates a perception that there's tons of buyers out there. Now, there's buyers out there. They're looking, but they're not looking and purchasing at no better, faster of a pace than they have been for the last 2 to 3 years. We just have seen a lot of these housing markets get cut. Their inventory's been cut 80, 90%. Compared to 2 or 3 years ago. Now, take my housing market, for example. I'm in the New Orleans metropolitan area, covering about 8 parishes. And out of 8 parishes, there's normally 12 to 14,000 homes on the market. That's what it was 2 years ago, 2.5 years ago. 14,000 homes on the market. Today, less than 2,000. Yeah, that's an 84% decrease in homes than what we seen 2 years ago. And we're not the only market. That's in every market. I have friends, people all around the country that sell real estate just as I am, and they all say the same thing. It doesn't matter what city, what state, inventory is low. So where did all the houses go? That's the $1 million question. Why aren't people putting their home on the market? 3 reasons come to mind. Now, we can't blame everything on the pandemic. And quite simply, everyone became remote workers. So many people were able to work remotely from their homes. So with the pandemic, it made people kind of stop, think, regroup, And in doing so, they refinanced their houses. They pulled out some cash. They did home equity lines of credit. They paid off credit cards. They bought new vehicles. They bought boats, motorcycles, RVs, you get it. And they, you, me, we, people, we are staying in our homes longer now than ever before. I think people are enjoying their homes more. They're enjoying their family more. You also have to think about this. Some 70% of the mortgages in the United States have a 4% or less fixed mortgage rate. So you can't help but wonder, well, if you're sitting in your house and you're thinking, where am I going to go? Where am I going to move? There's no homes on the market. And I've got a 3.5% rate. The second thing that caused the lack of inventory is the foreclosure moratorium. Now, keep in mind that the federal government said that a lender, a bank, no one could foreclose on a home for 16 months. And so as a real estate broker, real estate agents, brokers, we didn't see, literally over the period of a couple of months, all the foreclosures dried up and none have been back on the market. Now, home prices can climb and they can remain steady and stable and keep climbing as long as the buyers are purchasing them. Does that make sense? Now, how much it will increase is up to the market. It's up to me. It's up to you. It's up to the buyers, because they have to basically say, I'm not paying that. That's crazy. I'm not paying those astronomical prices. Now, listen, in some markets, buyers are making up the difference in cash. Some markets, people are purchasing houses for cash. I hear crazy stories, as you can imagine. People making up the difference in $200,000 to $300,000. And when I say making up the difference, I mean that a house goes on the market, you have multiple people making offers on the property, and the property has to appraise because the buyer's getting a mortgage. Well, the buyer's only going to put a certain percentage, certain monies down. After that, they have to make up the difference in cash. Otherwise, the seller doesn't have to sell on the property. They don't have to buy the property. But we're seeing people bring $20,000, $30,000 more. And some markets, it's in the hundreds of thousands of dollars over the contract purchase price. Now, one thing is for certain, which is good for home buyers, is that more and more foreclosures will be coming to the market. And I think that we're going to see a lot more of those, quite simply because we're rolling into the spring market and we're already seeing those houses hit the market. So how will the demand of houses decrease? How do you make buyers stop buying houses? If you have a low inventory and buyers are here and the market's crazy and they're paying more and inflation's through the roof, how in the world are you going to stop or slow down? You really don't want it to stop, but you just want it to slow down, right? For one, you simply raise interest rates. And this is why the Federal Reserve has and will continue to raise interest rates. And it's really simple. The whole purpose in that is to slow the rate of consumer consumption. And the key word here is slow, not stop. Just slow the rate of consumer consumption. Now, not to get negative, but you also have to understand at the same time that rates are being raised, it can push a person out of even a contention to purchase a house. In other words, where they could qualify at 3%, they can't qualify at 3.5%. Or they could qualify at 2.75, they can't qualify at 3.5%. And you're probably thinking, what difference does that make? What difference would a 0.5 percentage point make? Well, go with me just for a second. Not all starter homes are $150,000. Not all starter homes are $75,000. There's housing markets such as Portland, Oregon. The average sales price around the Portland, Oregon market is $570,000. Now, there's higher cities. Seattle, Washington, the average sales price $830,000. I mean, you look at Boston, Massachusetts, $680,000, the average sales price.
What? Bro, what are you talking about, man?
So think about that. You're going to purchase a house. It's going to be your first home. It's going to be a starter home. Now, keep in mind, I say average. Some of those are less. Some of those can be more. But if you take a starter home in Boston, Massachusetts, or Portland, Oregon, that's $300,000. You're talking about a $2,000 mortgage payment, $2,200 mortgage payment for a starter house. But here's where it gets even more interesting, because you're probably thinking, well, a $300,000 to $400,000 house or a $500,000 or $600,000 house in your market where you are, wherever that may be, and you're looking at what does a $500,000 to $600,000 house, $700,000 house look like in my market? Well, it's different in everybody's market. Most of these housing markets are no different than any other market, except for the price. So go with me on this. A 1,600 square foot house in Portland, Oregon will run you about $600,000. Now, that's well into the $375 a square foot range. That's a 3-bedroom, 2-bath, 1,600 square foot ranch home for $600,000. And if you don't believe me, just look it up. So are we in a housing bubble? No. Could we see a housing bubble? Of course, we can anytime. Will it be anytime soon? No, absolutely not. This is just my personal opinion, but there's just not enough inventory on the market to see a bubble. Will we see a shift in the economy? Possibly. But at the end of the day, who really knows? But here's what to look for. When you begin to see a lot of for sale signs pop up, when you begin to see a lot more homes come on the market, and those homes that are coming on the market are staying on the market. They're staying on the market 4, 5, 6 months. The price is going down and down and down and down and down. That lets you know that people are not buying those houses at those prices. And that also let you know as a consumer that the buyers are not purchasing those properties. When you see a market absorption rate of around 4 to 6 months, that too is pretty much an unbalanced market. You get back into a buyer's market. What we want to see is no more than 3 to 4 months worth of inventory. And that's basically the rate at which buyers are purchasing a house, and there's 3 months of inventory. So in other words, if not another single home is put on the market at the rate the buyers are purchasing properties, in 3 months that inventory would be down to zero. Now, I say that's never going to happen, but we'll just see how the spring works out. More than likely, we're going to see a lot more houses come on the market, which is going to be a great thing for home buyers. And of course, as we see those numbers hang around 3 to 4 months of inventory, that's when we see just a marginal increase in home values per year. Look, we all want our houses to go up. We all want to make money. But at the end of the day, we have so many people that have their homes on the market and are like, why would I put my home on? Where am I going to go? So be on the lookout for a lot of homes coming on the market, fewer people buying houses. And at the end of the day, until we see just a huge astronomical number of houses with crazy increased prices, at which time buyers stop buying houses, then we'll see the bubble burst. Until next time, thanks for watching.